My name is Greg Wilhelm. I'm a professor in the Business Administration Department at Wake Technical Community College in Raleigh, North Carolina. I teach classes both seated and online. This video is one of the series to try to ensure that my online students get all the same information I'm providing to my seated students. This particular topic is on retirement plans. And what we'll talk about, well, first of all, exclusions, what I'm not going to talk about. Then the two basic retirement plan types, defined benefit plans and defined contribution plans, the portability and cashing them out, and finally something about Roth IRAs. So what I'm not going to talk about is eligibility for retirement plans. They are not generally a legal requirement. Although if a business does not offer anything, they may be at a competitive disadvantage for hiring employees. I'm also not going to talk about the tax implications. Nor am I going to get into other retirement plans or hybrids of defined contributions and defined benefit. So the two basic types are defined benefit and defined contribution. And during most of our lives, we're going to spend some time working over there on the left, and then we're going to spend some time not working, which we call retirement. For defined benefit, and this is generally what's referred to as a pension. We work and work and work, and one day we stop working, and beginning on that time, we begin receiving a monthly payment month after month after month until we die. That is defined benefit. What's defined in the contract is what our benefit is, what we're going to get. The other type of retirement plan is a defined contribution, where during the time that we're working, we pay into a plan. Our employer may also pay into that plan for us. At the end of our employment with the company, we receive that stream of payments we put into it, perhaps with a little bit more as defined by the employment contract. We take our little bag of gold or silver and shake hands with our employer and wave goodbye. And that's it. So, defined benefit, we're going to get a monthly benefit, and it's going to be based on our years of service and our average pay, or the 10 highest, or some measure of how much we've gotten paid and earned at that company. Plus perhaps some additional amount if it's in the employment agreement. You may have to be vested. That is, you may have had to work there for 5 years, 10 years, some number of years before you're going to be eligible for the pension. You can receive it as a single life annuity, which means you get so many dollars every month until you die, and then it stops. Or you can arrange for your spouse or probably another person to continue receiving the benefits after you die. But if you do that, it will be a lesser amount because they're just using actuarial tables to determine the amount. Compared to this joint and survivor annuity, you may want to consider just taking the single life annuity and then investing in a separate term life insurance policy. It depends how the numbers come out. The funds supporting the pension could be in a funded, that is a qualified trust fund, the employee has typically no control over the investment types. The other is an unfunded defined benefit plan. Funded, there's a trust fund that's somewhat independent of the organization. Unfunded, there is no specific fund to collect the benefits. The benefits are going to be paid out from the organization's earnings somewhere. And it is a pool. You do not have an individual account. There's a pool of money that is paid out to the retirees. You do have an ongoing link with that organization. They or their trust funds are going to be paying you money over quite a long period of time. It's not portable. If you go from one company to another company, whatever you have there, if you're vested, will stay there. Something called ERISA, Employment Retirement Income Security Act. And that works with the Pension Benefit Guaranty Corporation that says if that trust fund dries up or for an unfunded pension fund, if the company goes bankrupt, there is some insurance so that you will be continuing to receive a pension, but it may not be as large as it was originally. The other type of retirement plan is defined contribution. And typically, a company will set up a 401k plan because it's advantageous to do so, especially with regard to the taxation. It is company-sponsored as opposed to an individual retirement account. The contributions to it are tax-deferred. Not tax-exempt, tax-deferred. The government will collect taxes on it someday. There is a limit on employee contributions, and depending on how it's set up, the employee may have some control over the investment types. Unlike the pension, the defined benefit, there are individual accounts for the defined contribution plans. Employer contributions, typically 50% of the employee contribution up to the employee contributing 6% of their pay. So maybe they'll be contributing 3% of our pay. There's a benefit you cannot afford to pass up. Now, their employee contribution may be stock, but it's still a good contribution. And there's probably a vesting requirement as well, not for the employee's contribution, but for the employer's contribution, there may be a vesting requirement. Separation is not equal to retirement. That is, you do not have to retire to get this benefit. Anytime you separate from that organization, you will receive the value of that 401k plan. The amount you're going to receive is typically the 401k assets plus some lump sum calculated by number of years of service and a salary measure, and maybe some sort of incentive for early retirement. You will not have an ongoing relationship with that organization. That's been severed. It is not covered by ERISA, and it is portable. If you're thinking, well, which one should I choose? There's not really a choice. Pensions, defined benefit, or the traditional type of retirement plan, very much defined contributions are where most organizations are headed these days. Portability. If you have a 401k plan at Company A and you move to Company B, you can pack that up and take it with you. You move again, you can pack it up and take it with you. One caveat is that you do not cash out your 401k and go redeposit it in Company B. You have to fill out some paperwork, and if they do actually pay it to you, you get stuck with the penalty. So one needs to be careful in transferring 401k plans. When eventually you move out of actively working, you probably want to transfer your 401k to a traditional IRA, independent retirement account, and the same caveat applies. It doesn't come to you, it goes to some bank for your benefit or something like that. If you're in that position, check with some financial advisor. Cashing 401ks and traditional or standard IRAs, you can withdraw beginning at age 59 and a half. Actually, you can withdraw at any time, but until then, there's a 10% penalty. You have to start withdrawing by age 70 and a half, and there's a table somewhere that says how much you have to draw after you reach 70 and a half. And the reason for this is the government's waited a long time to collect taxes on you, so they'd like to get that tax revenue. All withdrawals are taxable. Remember, those contributions to a 401k were tax deferred, not tax exempt. Another type of investment is a Roth IRA. And to be very clear, it's not an investment type. It's a tax treatment that has been defined. 401k, standard IRAs have a defined tax treatment, so do Roth IRAs. But the investments are things that are in that type of umbrella. 401ks and standard IRAs are pre-tax investments, and they're taxed at withdrawals. Roth IRAs are the flip side. We put post-tax investments in them, and then when we withdraw, the initial investment and any earnings are tax-free. Roth IRAs, if you contribute to them, that is, from your savings, whatever, put an investment into a Roth IRA, there's a $5,000 to $6,000 annual limit. If you're converting a standard IRA or a 401k to a Roth IRA, they call that a conversion, and there is no limit on how much you can convert. However, you still have to pay taxes on it. So one does not want to convert huge amounts because your tax bill will be higher than it has to be. That's it on retirement plans. My name's Dave Wilhelm. If you have any questions, feel free to email me.